Concern and confusion regarding interest rates and inflation urged the continued slide in stocks. Global equity markets suffered their biggest tumble this week in almost 4 years. Do the hammered stocks present a reason to buy in the U.S.? Well, for more on that, we are joined by Peter Schiff, Chief Global Strategist and CEO at Euro Pacific Capital. Euro Pacific manages around $400 million. And Peter joins us from Stamford, Connecticut today. Welcome.
Thanks for having me.
Let me ask you about broad trends here. We're seeing this sell-off, broad sell-off, U.S. stocks, emerging markets, gold. Is there a common thread?
Well, I think the only common thread is that the stocks or the asset classes that are falling are the ones that had been rising. And I don't think there's anything fundamental going on. A lot of the assets that are correlated together really have very little in common other than the fact that they have done very well, and I think they're owned by a lot of very leveraged players in the market. You know, you have something like 6,000 hedge funds, and a lot of times they use the word hedge fund, but there's not a lot of hedging going on. There's a lot of risk-taking going on, a lot of leverage. And when people borrow money to buy assets, that creates the potential for the type of declines that we're seeing when liquidity causes people to have to exit those positions, and you get a lot of people trying to sell the same assets at the same time. And some of them, like in the emerging markets, there's really not a lot of liquidity there on a daily basis. So when a lot of people are trying to do the same thing at the same time, you're going to have to see substantial declines in prices to accommodate the selling. And that's what we're having.
There is, though, however, one key global fundamental, and that is, of course, as you know, rising interest rates and inflation concerns. Do you factor that into your outlook, though?
I do. And certainly rising interest rates and higher inflation are bad news, for example, for home builders, and these stocks are falling. But I think things like precious metals, I think gold benefits substantially from inflation. And so the fact that both gold and home builders are falling together shows it's not necessarily the inflation fundamentals, it's more the liquidity concerns by the holders of these assets. And I think that when people put this into perspective, the market action of the past week or two has created a lot of opportunities in some of the assets that are only falling as a function of liquidity and leverage.
Which ones specifically, Peter? Which assets?
Well, those would be commodity-related assets, mining-related, oil and gas-related, foreign currency-related investments that have also come down because these assets have been owned by leveraged speculators, and I think they're in a sticky predicament right now. That is a good opportunity for long-term investors to take advantage.
Is the bull market in those commodities continuing, or is that what you're saying?
Oh, sure. I think it's ongoing. I think it's going to continue for many, many years. And, I think this is a buying opportunity. On the other hand, there are other assets that are owned by leveraged speculators that should not be bought, that are probably going to continue to fall because they were simply bought because of the momentum and the mania, not because of the fundamentals.
Where does gold price peak?
Well, I have no idea where it's going to peak. But I know that it's probably going to peak substantially higher than the $725 that was the most recent peak. I mean, we've now given back over $100 from that high, maybe $125. Long term, I think gold heads substantially higher, as do a lot of other commodities. And I think the dollar, which has gained some temporary support from the belief that the Fed is going to be vigilant on inflation, I think is ultimately going to collapse when people realize that that's just a bunch of talk.
You're not more encouraged by the trade gap becoming in better than expected today on the dollar?
Well,
better
than expected, it was $65 billion. It's a horrific trade deficit. It's like, I don't get excited if my son comes home and instead of getting an F on his report card, he got a D minus.
Okay, fair comparison. Where are you staying away from?
Well, I'm staying away from most U.S. assets in general because I believe a substantial decline in the dollar is going to undermine the real value of U.S. assets. But in particular, I would be very leery of anything related to the consumer, to the housing sector, to finance, particularly mortgage lending, the financial services area, or anything that's a very high multiple, technology stocks, anything that's really vulnerable to a rise in interest rates and a recession. Because I think that's what we have in the cards in 2007, a recession. And it's not going to be, one of these, mamby-pamby recessions that we had in 2002, but a real old-fashioned, recession.
Peter, we're running out of time. Too bad. Thanks for joining us.
Well, thanks for having me.
Peter Schiff is the Chief Global Strategist and CEO at Euro Pacific Capital.